So your new outlook now, 24.25 for the end of 2017 here. And it looks like it's based on the fact that you think earnings are going to rise. When you're looking at the various factors powering earnings higher, what percentage is based on this presumed fiscal policy and what's based on just underlying growth that we're seeing?
Sure. So let's start with the numbers. So we're looking for $131 next year now for the S&P 500 earnings, up from $120.50 this year. Of that kind of 9% increase, if you run the math, you're getting about 3 percentage points coming from the energy sector, looking stronger this year versus a year ago, given higher oil prices, and that translates into better numbers for the producers of oil and gas. In terms of the tax cut benefit, in other words, the stimulus program, we're just looking at a 20% tax rate, down from about a 27% effective tax rate for the S&P 500 currently. And that would add, exceptionally important here, only the fourth quarter. So we're assuming this is a fourth quarter 17 phenomenon, another couple percentage points. So if you kind of then look at the package, you're only looking for kind of another 4% or so coming from the rest of the market, which is pretty modest. For the following year, we actually introduced a preliminary number for 2018. We're at $146, and about $9 of that improvement comes from the Trump tax cuts. Now, we're not assuming anything about a stronger economy. We're not assuming anything about capital spending really getting potentially a boost from 100% depreciation write-offs. There are going to be offsets. We're going to find out a lot more details next year on this, but just simply on the lower tax rate, you get that bump to earnings, and as a result, you get some bump, and we don't think you get quite the same bump to the market as you do on the earnings front. In other words, we don't value tax-related earnings the same way we would value an improvement in kind of underlying operational leverage, because quite honestly, you could have a future administration take away that tax cut.
Right, it could be temporary, at least in theory. When you talk about valuing these earnings, I have a chart on the Bloomberg, which I can describe to you. I'm not sure if you can see it, that looks at the forward price-to-earnings ratio of the S&P 500. We're up around 19 right now. This is a 5-year chart, so it shows that we're more than one standard deviation away from the 5-year average of the forward PE. And of course, we've had this run since the election. So in your mind, where is sort of fair value at this point, given that outlook for earnings and given the run that we've seen and given that we're above sort of the near-term historical norms there?
So there are probably about 3 problems with the question, to be fair. First one is, even if I have valuation metrics, and we do, that notion of fair value, my opinion of fair value, doesn't really matter when you have millions of investors determining where they think that fair value is. So I think people who slap on their own PE expected level are somewhat arrogant that everyone's going to listen to them. Number 2, and more importantly, the 5-year time frame that you're talking about, also, if you put up the price to yield on the 10-year Treasury, you'd also see a fabulously crazy multiple on them, and nobody ever talks about bond markets being overvalued. In fact, if you go and look at a 20-30-year history and compare the two, we've had massive divergence between the two, where bonds look crazily overvalued relative to stocks, and stocks didn't get any of that benefit in the last 5 years. So I think the 5-year history kind of distorts the kind of real, if you want to call it, perspective. Sorry, my earpiece keeps coming out. And the third piece is, when we do think about valuation, we do this on a normalized earnings basis, but we also do it on a normalized bond yield basis. And on that basis, we have an 87% probability that markets will be higher in the next 12 months, looking back over 45 years of history.
Tobias, before your earpiece falls out, you graded yourself B plus for 2016. Not quite an A. Where did you fall short? And let's spin it forward also to 2017 on a sector basis. What's going to give you the A grade in 2017?
First of all, Mark, I'll tell you, I didn't get that many A's in school because I didn't apply myself that hard, and I'm a kind of tough grader on myself. But the 2 areas that we think we missed this year were, one, the extent to which the rally would occur, but I'm not sure many people would have really assumed kind of an 8% move since the election. So we had a target of 2150. We're closer to 2250 for this year, and that's part of the grade hurt. The second piece was that small caps have really run hard here again since the election, where most of the outperformance are tied to a stronger dollar, which we hadn't anticipated. So those are the two failures, if you want to call it, in our calls. I think we got a number of other things right. In terms of the coming year, I suspect the continuation of outperformance in financials and energy. I think there's a fair amount of pushback that these may have run too far, and we think there's an opportunity there for it to go further, given that we don't believe, and again, we may be wrong, but we don't believe that investors have fully embraced those views.